Hello and welcome to the Market Perspectives for the third quarter of 2017. My name is Matthew Adams, Chief Investment Officer at Mission Wealth. Turning to the key themes for the third quarter, we continue to see a domestic, international, and emerging markets stock rally underway. We've seen synchronized global growth and ongoing easy monetary policy leave conditions ripe for equity appreciation, but we have seen emerging markets in particular and developed international stocks outperform U.S. stocks year to date. Economic conditions, we are now in the second longest expansion in U.S. history, second only to the 1990s economic cycle. Those conditions still look good to us for moderate growth of approximately 2%, but for the first time in 6 years, we see international and emerging markets economies growing faster than the United States. In terms of valuations, we see U.S. equities in general near top decile by historic standards. We'll take a look at some of those slides. We do see pockets of lower valuations within international and emerging markets, and of course those economies are now growing a bit faster than the United States. This is all against the backdrop of really low volatility. This has been one of the lowest volatility environments really in history, and it's been quite some time since we've seen an equity market correction, but we do continue to keep our clients prepared for those unforeseen events through our diversification and multi-asset class approach. Turning our attention to global equities, we see double-digit returns really across the spectrum for U.S., international, and emerging markets. One of the themes that has reversed here in 2017 is that the strength in the U.S. dollar has abated. This has been a of ours for several years now, and we're now starting to see a bit of U.S. dollar weakness creep into the markets, and this in general is a trend that would be supportive of our portfolio, as we do have a good portion of the portfolio in unhedged international equity investments. The global rally, a nice chart to just highlight the difference between the S&P 500 denoted in gray and just how far that rally has come since the depths of the pullback in March of 2009, and then highlighted against the purple, which is the ACWI ex-US index. So this is a proxy for international and emerging market stocks. Trades at much lower valuations and just simply has not rallied as much. Still has rallied 100% since the lows of 2009, but could go further in our opinion. Taking a look at some economic indicators, we see consumer sentiment with the most recent reading of 98. 100 is the maximum, so we've really got very strong consumer sentiment. Rotation index doesn't tell us too much at the current moment, other than we've been in a period of risk on or equity flows for the better part of, let's call it, 6 months. And finally, we touched on this before, but the VIX index, often referred to as the fear index, is a measure of volatility in the markets, and still just at very low levels. We have not seen really any correction in quite some time here. This is obviously as difficult to predict as any market out there, but what we do know is that the cost to hedge and protect risky positions is as cheap as it's really ever been. Oftentimes this can be a counter signal. We'll continue to watch this, but just in general, financial sentiment indicators are at very high levels. Key forecasts for 2017, we show this chart in each of our market perspectives, but in general, the takeaway here is that we expect international equity markets to perform a bit better. We see bond markets as producing low single-digit returns, and that we still prepare our portfolios for a gently rising interest rate environment. Currencies, a bit more of a mixed bag. We believe that we're in a period where we're going to see the U.S. dollar stabilize and then potentially weaken in the years to come as international economies grow perhaps faster than the U.S. And then finally, down into commodities, the rebound in oil prices has been a consistent theme here for us, and we're still watching that and do believe that there is some upside in crude oil over the next year. Turning our attention to the economy, we made mention of this before, but we think that the U.S. economy will grow at approximately 2% In terms of inflation, we have seen some pullback in inflation measures in recent months. We believe that this is transitory. So does the Federal Reserve. And the belief is, with this final chart here, with the labor market being as tight as it is, that we should see some wage inflation passing through. And we do expect those inflation numbers to tick up and above the 2% level, which is the Federal Reserve's target for inflation. We made mention that global growth was synchronized, and this is a nice chart for indicating that this is a global manufacturing index, and any country or region that's shown in green or even dark green indicates a definite expansionary environment. So as we look at this chart here, what we see is that, in the far right-hand column here in June of 2017, you've got almost all greens across the board. You're seeing some excellent growth in the Euro area. Germany is the top reading of the bunch. But what's interesting is that global growth there of 52.6 in the top right-hand corner is actually demonstrating a higher number than U.S. growth at 52. Still an expansion here in the United States at 52, but this is the first time in 6 years that we've seen a reading where international markets are experiencing stronger economic growth than the United States. So that's a good signal. Turning to the consumer, most recent reading of the consumer balance sheet is a $110 trillion balance sheet. I think that's just nice perspective off of the low in 2009. So we've seen a gain of, let's call it 40 trillion, in assets. In terms of household debt service, not the same story as it was in 2007, 8, and 9. The debt service level is much lower, so we're in a much less leveraged position in terms of the consumer. And not surprisingly, household net worth has reached a new high with equity markets at all-time highs, as well as housing. Speaking of housing, we have a chart here on the average price for a single-family home. You can see the most recent reading of $287,000. This, again, is a national number. Has definitely broached the previous peak in 2005. And so combined with low interest rates, housing is quite affordable. And as another signal of strength, we've really seen lending standards increase. So it is harder to get a loan these days than it was, say, 10 years ago. But certainly that's a good thing in light of the financial crisis. So great signals here for the health of the consumer. In terms of the bond market, what we've been talking about is a gently rising interest rate environment. We've been talking about that for some time here. This dotted gray line here indicates where the yield curve was for all U.S. Treasury bonds in 2013, and the blue line indicates where they are at the most recent reading here in June of 2017. And so what we've seen is we've seen long-term rates fall, and we've seen shorter-term rates creep on upward. So it's those shorter-term rates that the Federal Reserve is a bit more in control of. Definitely the Fed funds rate, but those shorter-term market-driven rates do correlate pretty closely to that Fed funds rate. And this flattening of the yield curve has been a definite phenomenon. One of the charts I would like to highlight below here in terms of the duration of the Barclays U.S. Aggregate Bond Index, this is actually a significant change. The long-term average duration or interest rate sensitivity of the U.S. bond index had been below 5 years. And as we look at the most current reading, we've seen that aggregate bond index have a duration of 6 years. So this measures the sensitivity of the bond index if and when interest rates do rise. And just very important that we don't position our portfolio this long here in terms of our core fixed income here at Mission Wealth. Our target duration is closer to 3 3/4 years and not this 6-year index level. So it's very important. Investing in index is certainly a good way to keep costs low, but you want to make sure of the underlying characteristics of the index, and bonds are one index that we pay very close attention to. If we do expect yields to move upward as we do over time, just worth noting, again, this is a chart I've shown a couple of times, but that not all fixed income is created equal here. In fact, the shorter the duration and maturity of your bonds, and we talked about our duration being about 3 3/4, the less it would be negatively impacted in the event that interest rates do move upward. So in terms of this top portion of the chart here, we are positioned in a shorter duration position. And then on the bottom section, you'll notice that some types of bonds, like US high yield corporates, floating rates, and convertibles, have the opportunity to perform positively in a rising rate environment. So we've been adding to these satellite asset classes, such as floating rate and high yield corporate bonds, convertibles over the years. And so we believe that we're positioned well if and when interest rates do move up. Today being July 26th, as I'm recording this, the Federal Open Market Committee met today and had brief discussions about leaving interest rates pat for the time being, but they also did make mention of balance sheet normalization. So what that means is during the period of time under which the Federal Reserve was acting very aggressively and trying to stimulate our economy and asset prices, they wound up purchasing vast amounts of treasuries and mortgage-backed securities, as highlighted in this slide in blue and purple. By purchasing vast quantities, and we're talking trillions of dollars here, it had the impact of driving up prices and dropping the interest, the yields on those types of securities. The Federal Reserve has now stated that they intend to make some balance sheet normalization. Most in the markets interpret this to mean September of 2017, when they begin to let a bit of the air out of the balloon here in terms of their balance sheet. So looking forward to late 2017, we expect the Fed's balance sheet to begin to shrink from $4.5 trillion. We do expect the Federal Reserve to be very transparent and very open about the pace at which they're going to let these bonds roll off their balance sheet. But the general takeaway here is that this would be yet another factor that would drive interest rates up slowly but surely. A big, definite, unprecedented event, though, and we'll have to see how this pans out. Turning back to global valuations, and in terms of sticking with investments and being a long-term investor here, we look at the power of compounding here in the left-hand chart and show just how much compounded return one would expect from different asset classes, including stocks, bonds, and cash. Definitely very important to remain invested and allow these asset classes to work for you. The chart on the right-hand side discusses really an important feature, and that is, yes, it's important to remain invested, but it's also very important to ensure that your downside loss potential is at a reasonable level given your financial plan. So if you were to, say, lose 30% of your portfolio, as highlighted by this fourth bar from the left, you would need a 43% recovery in order to get even. So once assets are accumulated in retirement, it's really important to, yes, achieve those 5 or 6 or even 7% required rates of return, but it's really important to make sure that your downside protection is in place, because the gains to make up for losses in retirement are larger than the losses. Really important slide. Global valuations, some additional handy charts here, just talking about the different regions in which investors prefer certain types of sectors. Unsurprisingly, here on the West Coast, we see that many investors prefer technology stocks. Taking a look at the United States in terms of our percentage of global GDP and in stock and bond markets, you see that we make up about 20 to 30% or so GDP and global equity and bond markets. But for the most part, U.S. investors are heavily U.S. centric and tend to not have as much global diversification. We here at Mission Wealth definitely believe in global diversification. And as we highlighted before, we believe some of those international and emerging market stocks really have the potential to carry performance going forward as the U.S. markets have been in a leadership position for many years now. More information on valuation ranges. Looking at the top right-hand chart, we see the S&P 500 trading at about nearly 18 times forward earnings. You can see that the blue rectangle there denotes the range within one standard deviation of where it normally trades. The gray box within is the median. So just in very normal basic terms, the S&P typically has traded with a forward PE of about 15 and is now trading at about 18. So you could make the argument that U.S. stocks are a touch on the expensive side. Compare that to the Stoxx 600, which are European equities trading at 15 times, or even the MSCI EM index, which is emerging markets trading at just 12.6 times. So there are pockets of better valuations globally. Certainly the United States has a safety premium that we are very cognizant of, but we do believe that global diversification will have long-term benefits for our clients. So in terms of the actions that we've taken, we've been rebalancing portfolios and in general diversifying out of equities into other asset classes that have either a lower risk profile or have greater return potential going forward. Looking ahead, we expect a gently rising interest rate environment. There's still a big focus out there on Congress and what they might do with potential corporate tax reform. And then finally, we're looking for some of the themes of U.S. equities and U.S. dollar outperformance to begin to abate over the years to come. And, we do believe in being globally diversified, stocks, bonds, alternatives, and we believe that that offers our clients the best chance to weather not only good times, but also difficult market environments looking ahead. So, with that, I'd like to thank you for your attention to this Market Perspectives. Should you have any questions, hesitate to reach out and contact your client advisor.